Hello students, welcome to Accounting Explained at AccountWise Academy. This is Alatha Venkateshwaran. In this video, we are going to learn about provision for depreciation. Students, I am going to give a brief description about depreciation before going in depth about provision for depreciation. See, I have uploaded videos on straight line method and return down value method, that is WDV method. Previously, you can go through those videos for a better understanding. I'll be sharing the link in the description box. There in the videos I have solved even the probable questions which you are going to get for your exams, and it will be a very good revision for you before you go and sit for the exams. Okay, now coming to depreciation. Depreciation refers to the decrease in the value of assets of the company over the time period due to use, wear and tear and obsolescence. So when you use any asset, fixed asset, for example, you are using phone. The phone will lose its value over a period of time. That is over 3 months, 4 months time itself, the phone will decrease in the value and it might become old because of usage, wear and tear and obsolescence, that is change of technology. Okay, the same thing applies to the fixed assets which we use for companies also. It is a method to allocate the cost of an asset over its useful life. Suppose the cost of an asset, that is machinery for example, 1 lakh. You bought the machinery for 1 lakh. You are not going to take directly this 1 lakh for the first year. Okay, if you take it directly to the 1 lakh to the first year, being a fixed asset, then it is not correct. You are going to take it over a period of time. For example, if you are going to follow straight line method of depreciation where it is depreciated at 20%. So it is going to be depreciated over a period of 5 years. So every year you are going to take 20,000 only as the depreciation. Okay. Because 5 years is considered as a useful life of the asset which you have bought. Depreciation is always charged on the cost price of the asset and not on its market price. This is very important because in the exams they might confuse you. They might give you the market price, which is wrong. You should not take. You should take only the cost price of the asset. It is charged every year to the extent of the depreciable amount. So in this example, what is the depreciable amount? It is 20,000. So you should charge depreciation only to the extent of 20,000. It should not be lesser than that, nor it should not be more than that. Now let us see examples of fixed assets that can be depreciated. Machines, computers, furniture, vehicles, etc. are all the assets or fixed assets that can be depreciated. Creating provision for depreciation or accumulated depreciation account. This method involves accumulating depreciation charges every year into an account rather than directly charging it to the cost of the given asset. So every year, instead of taking it to the fixed asset, the depreciation of 20,000 which we saw in the previous example, right? That instead of taking it to the fixed asset, now we are going to take it to a new account called provision for depreciation account. Okay, fixed asset will remain the same. The account prepared for such purpose is called provision for depreciation account. A depreciation provision allows a company to account for the gradual decline in the value of the fixed assets over time, thus allowing the company's financial statements to accurately reflect the current value of its investment in those assets. In the previous example, machinery was taken at a value of 1 lakh, right? And per annum depreciation was 20,000. So first year machinery value will be 1 lakh, accumulated depreciation will be 20,000. This is first year. Second year machinery value will be 1 lakh, accumulated depreciation will be 40,000. So on seeing the accumulated depreciation and machinery account separately, we can see where the machinery value, what the machinery value is. So 1 lakh minus 20,000 is 80,000. So instead of deducting depreciation directly from the machinery, we are going to maintain a separate account called accumulated depreciation. Let us see the journal entries for provision for depreciation. Okay, the first entry is asset account debit to bank or vendor's account. When the fixed asset value increases, it has to be debited. That is why asset account is debited. And if you are going to buy by giving money, then bank value decreases, so bank has to be credited. If you are going to buy on credit, your liability increases. That is why vendor or your creditor is credited. Okay, being fixed asset purchase is the narration. Next entry for charging depreciation. For charging depreciation, the entry is depreciation account debit to provision for depreciation. Depreciation is an expense. When the expense increases, it has to be debited. To provision for depreciation, you are creating a liability on fixed asset because you are going to decrease the fixed asset every year. No, that is why you are creating a liability on the fixed asset. When the liability increases, it has to be credited. And the narration is being provision for depreciation account created. Next, this depreciation you have created, no, that has to be transferred to the P&L account. For transferring the depreciation to the P&L account, here depreciation is debited. Now to transfer it, it has to be ulta. So you have to credit it. So the next journal entry is first you credit to depreciation account. Where it has to be transferred? Obviously it has to be transferred to a P&L account because it is an expense and your profit is going to be decreased. So profit and loss account debit. Your expense is going to increase. That is why profit and loss account is debited. Being depreciation for the year charged to P&L account. Understand the flow of the journal entries. You will be able to write any journal entry easily. That is why I am explaining each and every journal entry separately. Okay. Now these are the entries you are going to pass every year for provision for depreciation. Okay. Let's solve a question on provision for depreciation. Question is as follows. GFG Limited acquired a machine for rupees 1,80,000 on October 1, 2021 and spent rupees 20,000 for its installation. The firm writes off depreciation at the rate of 10% on the original cost every year. So original cost means straight line method, SLM. Okay. Record necessary journal entries for the year 21-22 and draw up necessary accounts for the first 3 years given that the books of accounts closes on March 31 every year and the firm maintains provision for depreciation account. Okay, this is the question. Now for the machinery value, you have to take cost of the machine plus installation charges. If you had seen my previous videos on straight line method and WDV method, I would have explained all these things in a very elaborate manner. Now when you want to know the cost of the asset to be taken to your books, it should be cost of purchase plus installation, that is 1,80,000 plus 20,000. 2 lakhs should be taken as the book value of the fixed asset that is purchased. Okay. This is the question and this is the solution. Okay. Before starting, we have to write in the books of GFG Limited. First, what they have asked in the question, they have asked us to write journal entries. No, journal entries. Okay. And the format for journal entries: date, particulars, LF, amount debit, amount credit. For provision for depreciation, first year 3 entries are mandatory. First for the purchase of fixed asset, then second is for creating provision for depreciation, and third is for transferring depreciation to P&L account. And afterwards, for the coming years, only 2 journal entries are needed. That is for creating provision for depreciation every year and for transferring depreciation to P&L account. That's all. This is the format for provision for depreciation account. Now let us see the solution. First, they have purchased machinery on October 1, 2021. So what is the cost of the machinery we saw? We saw it as 2 lakhs, no, 1,80,000 plus 20,000. So the first year, October 1, 21-22. Okay. Entry is machinery account debit to bank account. Machinery is an asset, fixed asset. When the asset increases, we have to debit it. So we are debiting it 2 lakh to bank account. Bank is a asset. When the asset value decreases, we have to credit it 2 lakh. Being machinery purchased and installation charges paid is the narration. So what is the second entry for creation for provision? That should be done at the end of the year. So we saw in the question that every year the book closes, they close the book on March 31st. So we have to pass the entry for creating provision on March 31st. Entry for that is depreciation account debit to provision for depreciation. Depreciation is an expense. When the expense increases, debit it. Similarly, provision for depreciation is you are creating a provision liability on the fixed asset. So when you are creating a provision or increase the liability, it has to be credited. That is why do provision for depreciation. And the amount is, we have purchased it on October 1, right? So we have to calculate depreciation. Rate is 10%, okay? From October to March. From October to March it is 6 months. October, November, December, January, February, March is 6 months into 6 by 12. So it is 10,000, 10,000. Being provision for depreciation account created. Next, what did we see? This depreciation has to be transferred to P&L account. So similarly, same date, March 31. Here depreciation is debited. Now you are going to credit it to depreciation since you are transferring it or cancelling it. And profit and loss account has to be debited because your expense side is going to be increased in the profit and loss account. So that is why it is debited 10,000, 10,000. From the coming year onwards, from the next year onwards, we are going to pass entries only 2. Okay, what are those entries? Creation for depreciation, creation for provision for depreciation, and transferring depreciation to P&L. So 22-23, March 31, depreciation account debit to provision for depreciation. For this, depreciation amount will be for the whole year because this is second year, no? 2 lakh into 10 by 100, it is 20,000, 20,000. Being for depreciation, provision for depreciation account created. Next on March 31, transfer this depreciation to P&L. P&L account debit to depreciation. Being depreciation for the year ended, charge to P&L account. Okay, 20,000, 20,000. Next 23-24, same 2 entries. March 31, depreciation account debit to provision for depreciation account. Again depreciation for the whole year, 20,000, 20,000. Again March 31, transfer this depreciation to P&L. P&L account debit to depreciation account, 20,000, 20,000. Being depreciation for the year, charge to P&L account. We completed the journal entries. Now we are going to post the journal entries in the ledger accounts. In the books of GFC Limited, first we have to write machinery account. On the left side it is DR, on the right side it is CR. And on the left side we have to open columns date, particulars, JF amount. Again right side date, particulars, JF amount. This is the format of any ledger account. Okay, first for purchase of machinery, 1,80,000 plus 20,000. 2 lakhs is the cost we have to take to the books. That is what we saw. So the journal entry for purchase of machinery is machinery account debit to bank, right? So here we have opened machinery account. In the journal entry we have credited bank account. Now in the machinery account we are going to debit bank account. We have purchased on October 1, 21-22. So to bank 2 lakhs. No other purchase or sale is there during the course of the year. So we are going to take 2 lakhs total on both the sides because debit side total is more. On the credit side we are going to write on March 31, 22-23 by balance carried down 2 lakhs. This balance has to be brought forward to the next year 22-23 April 1, to balance brought down 2 lakhs. Again there are no purchases or sales. Debit side total we are going to take to both the sides. On March 23-24 31 by balance carried down 2 lakhs. This has to be brought forward on April 1, 23-24 to balance brought down 2 lakhs. No purchase or sales during the course of the year. So March 31, 24-25 it is by balance carried down 2 lakhs. Debit side total should be taken on the both the sides. This is the machinery account. Next account to be opened is provision for depreciation account. Okay, we created provision for depreciation. The entry for that is depreciation account debit to provision for depreciation, PDD. Okay, Here in the journal entry we have debited depreciation. In the provision for depreciation account, we are going to credit depreciation. By depreciation account on March 31, 21-22, 10,000. That is the depreciation amount we took for, because it is for 6 months from October 1 to March 31st. Credit side is total is more, so we are taking credit side total to the both the sides. And on March 22-23, 31st is the date, to balance carried out 10,000. This has to be brought forward on April 1, 22-23 as by balance brought down 10,000. Again 23-24 on March 31 we created depreciation for the whole year by depreciation 20,000. Okay. So on seeing we find the credit side total is more, so take 30,000 on both the sides. On 23-24 March 31 to balance carried down is 30,000. This has to be brought forward on April 1, 23-24 as by balance brought down 30,000. Again on March 31, 24-25 we created provision for depreciation by depreciation account 20,000. Seeing credit side total is more, take the credit side total to both the sides. On 24-25 March 31 to balance carried down is 50,000. Next we will open depreciation account. Okay, for depreciation we passed an entry for creating for depreciation. What was that entry? The entry was depreciation account debit to PDD. In the journal PDD is credited. So in the depreciation ledger account PDD has to be debited. March 31, 21-22 to provision for depreciation 10,000 rupees. Again this depreciation we transferred to P&L account, right? The entry we passed was P&L account debit to depreciation. So here P&L account is debited. In the depreciation ledger account it will be credited. Same date March 31, 21-22 by P&L 10,000. Now the account is tallied. Take the total on both the sides. So there will be no carried down or brought down. Next year March 22-23 March 31, date is March 31. To provision for depreciation. This year we created provision for the whole year because it was from April 1 to March 31. 20,000 rupees. Again depreciation has to be transferred to P&L account March 22-23 31 March 31 22-23 by P&L 20,000. Account is tallied. Take 20,000 on both the sides total. March 31 23-24 to provision for depreciation. Credit provision for whole year 20,000. Transfer depreciation to P&L account. So March 31 23-24 by P&L 20,000. Take the total of 20,000 on both the sides. Account is tallied. With this we are completing this part 1 video of provision for depreciation. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.